In March of 2024, a 26-year-old woman in Ohio opened her banking app to check her balance and found something that terrified her. It wasn't a single missed payment. It wasn't one bad purchase. It was 14 separate buy now, pay later plans, spread across 5 different apps, all coming due in the same 11 days. She hadn't taken out a loan. She hadn't walked into a bank and signed a stack of paperwork. She had just shopped, one tap at a time on a phone screen, in the space between scrolling and buying. And somewhere between the shoes, the groceries, and the birthday gift for her niece, she had quietly built a debt she never saw coming, spread so thin across so many apps that not one single company and not one single credit report could have warned her. She is not alone. She is one of roughly 400 million people worldwide who have used a service like this, and she is quietly becoming part of a very old economic story, wearing a very new, very friendly disguise. Here's the thing about buy now, pay later. It doesn't feel like debt. It feels like a discount. You're standing at checkout, the total pops up, and right underneath it, a friendly little button offers you a different way to pay. 4 payments instead of 1. No interest, no credit check, just a checkbox. And in that half-second decision, something strange happens in the brain. The purchase stops feeling like spending and starts feeling like a deal you'd be silly to pass up. That feeling isn't an accident. It's not a happy side effect of good design. It is, quite literally, the entire business model. Buy now, pay later was engineered from the ground up to make debt disappear from view. And when debt becomes invisible, people take on far more of it than they ever intended to. So here's the problem. Laid out plainly, millions of people are stacking multiple buy now, pay later loans at the exact same time across completely different apps, and almost nobody, including the people doing it, is tracking the total. One plan on its own looks harmless, $10 a week for a pair of shoes. But the average user isn't making one purchase and stopping there. They're juggling 3, 4, sometimes 6 separate payment plans simultaneously, each one small enough to shrug off, and all of them together large enough to quietly wreck a monthly budget. It's death by 1,000 $10 cuts. And unlike a credit card statement, there's no single piece of paper that adds it all up for you. To really understand why this matters, you have to rewind about 30 years. Credit cards were, in a sense, the original buy now, pay later, but credit cards came bundled with something that acted almost like a seatbelt. An interest rate that punished you for carrying a balance. A minimum payment that forced you to acknowledge the debt every single month. A credit score, quietly watching in the background, ready to drop the moment you slipped. That system was annoying. Nobody liked getting a credit card statement, and nobody enjoyed watching their score drop after a rough month. But the friction did something important, something we're only now realizing we lost. It made people pause. It forced a small moment of reckoning once a month, whether you wanted it or not. Buy now, pay later was built almost point by point to strip that friction away. No interest as long as you pay on time, no hard credit check to slow you down. And critically, no single company that can see your full picture, because you're not just using one app, you're using several, and none of them are talking to each other. That's precisely why it grew the way it did. Global transaction volume in this industry sat under $30 billion back in 2019. By the middle of this decade, it had rocketed past $300 billion. That's roughly a 10-fold increase in about 5 years. For context, that is a faster growth curve than credit cards had in their first 2 decades of existence, and faster than subprime mortgage lending grew in the years leading up to 2008. Growth that fast, in lending of any kind, tends to be the kind of curve economists start circling in red pen right before something breaks. History doesn't need the exact same product to repeat the exact same mistake. It just needs the same ingredients. Easy access, low visible cost, and a story that makes participation feel less like risk and more like common sense. Tulip bulbs in 17th century Holland weren't inherently dangerous either. Neither were dot-com stocks in 1999 or mortgage-backed securities in 2006. In every case, the danger wasn't the product itself. It was how quickly and how invisibly ordinary people were able to pile into it without anyone, including themselves, keeping an honest count. Now here's where it gets genuinely fascinating, because this isn't just a story about apps and interest rates. It's a story about psychology. Behavioral economists have a specific name for what buy now, pay later is exploiting, and it's called payment decoupling. When the pain of paying gets separated from the moment of buying, people spend more. Simple as that. Credit cards already do this a little because swiping plastic hurts less than handing over cash. But buy now, pay later does it dramatically more, because it doesn't just delay the pain, it slices slices it into pieces so small they barely register as pain at all. Research on checkout behavior has consistently found that shoppers using installment options spend noticeably more per transaction than shoppers paying the full amount upfront, sometimes dramatically more. This technology isn't simply offering flexibility to people who need it. It is, by design, engineering bigger purchases, more frequent purchases, and less hesitation all at once. Think about how that plays out in a real checkout. A $120 jacket paid in full forces a moment of hesitation. Do I actually need this? A $120 jacket broken into 4 payments of $30 skips that hesitation almost entirely because $30 feels like a small, forgettable number, even though the jacket and the total cost never actually changed. The price didn't move, only the perception did. And that shift in perception, multiplied across hundreds of millions of shoppers and billions of transactions, is exactly how you get a tenfold jump in industry volume in half a decade. The convenience is real, but so is the manipulation baked into the convenience. Here's the part that should genuinely worry you. Because buy now, pay later loans typically don't show up on credit reports, there is an entire layer of debt that's completely invisible to the traditional financial system. A bank reviewing your mortgage application has no way of knowing you're currently paying off 6 different purchases spread across 4 different apps, which means the system that's supposed to be measuring how leveraged everyday people actually are is systematically underestimating it. And if that setup sounds a little familiar, it should. It echoes in a smaller and more personal way exactly how subprime mortgage risk got hidden and repackaged in the years before 2008. Not identical and nowhere near the same scale, at least not yet. But the underlying flaw rhymes perfectly. Risk that has become invisible to the very people whose job it is to measure it. And this isn't theoretical anymore. The evidence is already showing up in the data. Surveys of buy now, pay later users have found that a significant share, in some studies more than a third, admit to missing at least one payment. And missed payments trigger late fees that can quietly turn a zero-interest purchase into a genuinely expensive one. Delinquency rates across this industry have been climbing steadily, and the trend that should really catch your attention is who's driving it. It's disproportionately younger borrowers, and they're not primarily using these plans for sneakers and gadgets anymore. They're using them for something far more revealing. Groceries, gas, basic household bills. When people start splitting a grocery run into 4 separate payments, that's not a shopping trend anymore. That's a signal, a flashing one, that everyday costs have outpaced everyday income. And buy now, pay later is quietly absorbing the gap, one invisible installment at a time. And it's not just outside researchers raising the alarm. Internal reports from some of the largest buy now, pay later providers themselves have quietly acknowledged rising loss rates, even while their marketing continues to lean hard on words like freedom, flexibility, and control. That's worth sitting with for a second. The companies profiting most from this growth are, in their own risk disclosures, admitting that more of their customers are struggling to pay them back. That's not a red flag hiding in the fine print. That's a red flag printed in bold right next to the smiling ad. Step back for a second, because this is the part that should feel eerily familiar if you know any economic history at all. Every major credit expansion in modern history follows almost the exact same script. A new financial product arrives and removes friction. Adoption explodes because it feels effortless. Usage quietly drifts from convenience toward necessity, and risk builds up in places regulators simply aren't watching yet because the product is too new, too fragmented, too fast-moving to fit into the old rules. It happened with credit cards in the 1980s. It happened with subprime mortgages in the 2000s. The technology changes, the packaging changes, the name on the app changes, the underlying pattern does not. So what happens next? Regulators in several countries have already started moving to bring buy now, pay later under the same kind of oversight that governs traditional credit, which would mean real credit checks, mandatory reporting, and actual consequences for missed payments. If that happens broadly, it will almost certainly slow the industry's growth, and in doing so, it will expose just how many people were quietly leaning on this to make ends meet. The same way rising interest rates in 2007 slowly peeled back the layers of who could actually afford their mortgage and who couldn't. For the average person listening to this right now, the takeaway is a lot more personal than a regulatory headline. If you're not actively tracking every single buy now, pay later plan you're currently enrolled in, right now, across every app on your phone, you genuinely do not know your real monthly debt load. And here's the uncomfortable part. Neither does anyone who might be lending to you next, whether that's a mortgage officer 3 years from now, a car dealer next spring, or another buy now pay later app approving you for a fifth plan without ever seeing the other 4. Buy now pay later isn't a scam. And it isn't some villain twirling its mustache behind the scenes. It's a mirror. It's showing us in real time just how comfortable an entire generation has become with debt they genuinely cannot see. Because the 2008 financial crisis wasn't caused by one catastrophic loan, signed by one reckless bank in one fateful meeting. It was caused by millions of small, individually forgettable risks, scattered across millions of ordinary households, quietly stacking on top of each other for years until the day nobody, not the banks, not the regulators, not the borrowers themselves, could see the whole picture anymore. Buy now, pay later might still be small, relative to a mortgage crisis that took down entire economies. But so was every bubble in history, right up until the exact moment it wasn't. The shoes are $10, the groceries are $10, the gift for your niece is $10, and somewhere on 14 different due dates spread across 5 different apps, the bill for all of it is quietly coming due.